All right, welcome everybody. Thanks for joining today. You are seeing Josh and Brian, as you all know. We also have Sarah Orvin, who's with Artisan Partners. She's our featured guest speaker for the day. We're going to talk for a little bit, or Josh is going to talk for a little bit about some things going on in markets, and then we're going to jump into Sarah's presentation. And for those of you who did not join us last time, we'll have a Q&A at the end. You'll be able to put questions into your Zoom app or browser, and we'll take questions for both either Josh, myself, or Sarah when we're all wrapped up here. Sarah, you hearing us loud and clear? Great. All right, Josh, what are we looking at?
So today we're going to talk about one of my favorite strategies that we invest in. And so much of the media's attention and a lot of investors' attention is on the US stock market. So the ups and downs make their way onto our social media feeds, newspapers, magazines, etc. But there's a lot more going on in the world than just the US stock market. And from an investor standpoint, we are always trying to find things that are different from the US markets. So when we have an event like this year, when the markets were down almost 20%, we would love to have things in our portfolios that are flat, maybe up, but doing different things than the market in the US. So that's called diversification, and it serves investors really well. And this fund that we're going to talk about today primarily invests in emerging markets bonds, and it can choose which currencies it wants to invest in. And just to give a little high-level updates on what's growing on in emerging markets, they've been growing a lot faster than the US and the developed world. And a lot of that's driven by population growth. So population growth tends to be a lot faster in a lot of these markets. So with more babies comes more workers and a bigger economy. From a sizing standpoint, the purplish color shows the growth of emerging markets bonds as an asset class over the last couple of decades. So the gray, you can see the US, 57 trillion with the T, and emerging markets are now almost that size. So you've seen a lot of growth in emerging markets bonds, and the yields that investors can get are often higher. And that's pretty exciting for managers like Sarah. That allows her to get hopefully high single digit, maybe even 10%-ish returns on some of their bond positions. So this chart shows the starting yield that we are in a lot of different parts of the bond market, not just emerging markets. And it's a little bit of a noisy chart, but if you look at the blue diamonds, they're almost always higher than the purple bars. And the purple bar is what the yields have been on average the last 10 years. And the blue diamond is where they are today. So we're getting a lot better yields across the board in almost every part of the bond market. And in some cases, 8, 9, 10% yields are possible. And if you think about the stock market, it's delivered 8 to 10% returns over long periods of time. But you can often get downside of minus 30%, minus 40%. So if we can get stock-like returns with far less risk, that's a pretty exciting opportunity right now. So Sarah works for an investment company called Artisan Partners. As we've told a lot of our clients over the years, given our independence, we can invest in almost anything that exists. And we love that open architecture. So that allows us to scour the universe for really talented managers like Artisan. And one of the things that we like about Artisan is they are exclusively focused on investing. So they don't have a bank, they don't have a bunch of other business lines to worry about. All they do is focus on investing. So we use 2 Artisan funds. One invests in stocks outside the United States, which is on the left-hand side. The fund that we're going to talk about today is on the right-hand side. Artisan Global Unconstrained is the name of the fund. And Sarah's going to give us a lot more information on it here in a few minutes. But since the fund has been around in its current form at Artisan for about 3 years, the fund has performed at about 9%, which is extremely exciting. We've actually invested with this team for over a decade. So Sarah and some of her teammates were at a different investment company and switched over to Artisan a few years ago, and we followed them when they made that move. So we talked about emerging markets. Sarah's going to probably tell you about all the countries she's been to. I'm guessing it's a pretty high number, but this chart shows what's in their universe. So I think it's probably about 2/3 of the world's population lives in emerging markets, Brazil, India, China being big ones. But there's a lot of other countries that are in that world that Sarah and her team can invest in. And we think there's a lot of opportunity for investors who are able and willing to do a lot of work, travel, and meet with these countries and their leaders and figure out what are some good opportunities to invest in their currencies and their bonds. This slide highlights how a lot of these countries don't have analyst coverage, meaning not very many people are looking at them. And some of the best investment opportunities exist when there are not a lot of competition and not a lot of other investors trying to invest there. So we think that gives Sarah's team an advantage that they have the size and scope to research these places and have followed these countries for decades in many cases. So Sarah, we're going to go ahead and flip it over to you. I know there's a couple countries in specific you want to talk about, but I'm sure you'll do a way better job explaining the strategy and what y'all are trying to do. So we'll flip it over to you.
Oh, thank you. So as Josh mentioned, my name's Sarah Orvin. I'm one of the portfolio managers at the Artisan Partners M-Sites Capital Group. Our team sits in Boston, Massachusetts. As was previously mentioned, several of the members of the team, the founding members of the team, all came together from another asset manager to Artisan in 2021 and proceeded to set up several investment vehicles, including 2 U.S. mutual funds, one of which I want to talk about today. And we've just passed our 3-year track record on that strategy, the Artisan Global Unconstrained Fund. So we're very excited about that. So the strategy is a long-short fund, and it has 3 main goals. I would describe these as the first goal being earning returns over the risk-free rate. So, providing return in all sorts of market environments beyond what one would expect to earn holding cash in the United States. If we're going to get excited about putting someone's money in Uganda, there better be good reason for that, right? So the second goal would be strong risk-adjusted returns. So not just return for the sake of return, but returns that make sense given the risk and volatility that's inherent in any investment that we're making. And our final main goal, I would say, is to be an uncorrelated diversifier. So to create a strategy that behaves differently from things that people already own in their portfolios, whether it's US stocks or global stocks, US interest rates, other kind of traditional instruments. And so let's see, let's flip the slide here, please. So how do we do that? The way that we approach this is to open up the whole world as our opportunity set. And when we say emerging markets, we are talking about a lot of different markets. And actually in Global Unconstrained, we don't limit ourselves to emerging markets. We can make investments on the long or short side in developed markets as well. So that gives us an investment universe of 130 plus countries that we are following closely for both fundamental changes in events, policies, politics, economic outcomes, and opens up a very wide world of assets that we can look at for this strategy. And the assets that we invest in this strategy include currencies and the short-term interest rate that they hold. So don't think of, like some Korean won note that you might have in a drawer that's earning 0 interest rate, but we're also earning the local short-term interest rate when we invest in currencies. local interest rates. So just like the US Treasury issues bonds, governments all over the world issue Treasury bonds in their own currencies as well. And so we can take a view on the long-term interest rate in those countries, spreads on bonds that countries issue in what we call hard currencies. So think of the US dollar as a hard currency that other countries can't print. That's what you might hear referred to as sovereign credit. If you hear that a country has external debt problems, they're talking about problems finding dollars to pay back external debt. We also invest in bonds that companies issue in markets around the world. And we, to a smaller extent, will invest in equities in other countries and commodities as well. And the way that we do this research process, we read daily news in all these countries every day. We have a team here in Boston that is constantly reaching out to and fostering a network of local contacts that can help us identify and interpret events when we're here in the office. And then we also travel a lot. We get out on the road. It says 50 to 70 country visits yearly here. Already this year, we've been to places like Kyrgyzstan, Kazakhstan, Ecuador, Argentina, Bangladesh, Rwanda, and I'm headed out to South Africa next week. And so we will we'll get on the ground where and when it makes sense, and do a couple of things, try to enhance that research process and fact finding type of activity, build that local contact network out further so that we have the right people to call and contact when we're back at home. And then also source new investment opportunities. Often travel is a great way to connect with either companies who are thinking of issuing bonds, policymakers who want investors' thoughts and advice on what kind of assets might be interesting next. So we find travel to be a very important part of the process. And I'll ask you to move one slide forward, please. So this is, I guess, maybe a little redundant to a graph that was shown already, so I won't dwell on it too much here, but just some return numbers since inception, and it has been just over 3 years now for us. And I would actually ask you to focus on that excess returns number, so 17% over what one would have earned holding 3-month T-bills in the US. So that's the number that we focus on here, and that's cumulative over the 3 years and a month, or I guess this is through March, 3 years. And then let's jump ahead to slide 6, please. This just shows how we've performed in different environments, and we don't need to hang out here overly long unless someone has questions about that.
Sarah, real quick on this.
Yeah.
One of the things we love about the Artisan Fund is when the stock market is down 20 or 30%, it's really nice to have things in our portfolio that are not down that amount and maybe even flat or up.
Yeah.
And I think this kind of demonstrates that your fund has been able to do that. And even this year, when you had a very big disruption in global trade, I feel like you could speak to, the market in the US was down almost 20%. I think your fund was down maybe 1%, if that, maybe up.
Yeah.
So it's doing exactly what we were hoping it was going to do.
Well, thank you so much for saying that. I was just looking at April, and I think, obviously very volatile period there. This strategy was down 0.5%. We're up year to date. We'd like to do better. We would have liked to have been up in the month of April, but yeah, I mean, I think in terms of just being different than what's going on in the US or what's going on in other kind of big global risk factors, I think broadly we're happy with what we've been seeing this year. So. And
we can skip past this one.
yeah, just what, and yeah, just here down at the bottom, the Sharpe ratio there. So this describes how we're doing in terms of providing units of risk units of return per unit of risk. Higher numbers, generally a smoother, better ride. And so that 1.89 number is something that we're excited to see, but also, working to get higher over, in the future as well. So let's skip ahead one more. Okay, so where do we invest and what makes us a bit different? So the first country I want to talk about is Uzbekistan, which is probably not the first market that comes to mind when people hear emerging markets. It is in Central Asia. It's one of the few countries in the world that has the honor of being double landlocked. It's a massive country. They've got some natural resources, as one might imagine, and you might hear it going forward in the context of the ever-developing critical minerals story. But I think what's really interesting for us in Uzbekistan is actually the policymaking story. So they had a new president come in 2016 after many years of the same kind of post-Soviet autocrat. This president is ruling a bit differently in that he has focused all his policy making on opening up the economy to the rest of the world. So when you think of Uzbekistan prior to his time, think of one of the last unreformed post-Soviet economies, very little trade interaction with the rest of the world, very strict laws about access to foreign currency, completely state-owned across all major sectors. And over the past 9 years, they've done a lot of work on the legal framework and regulatory framework to begin the process of liberalizing. There is still a lot to do. I mean, when I was in Uzbekistan in February, I got excited because there were less than 15 officials that came into the meeting with the biggest state-owned bank, and a lot of the banks are still owned by the state, but their goal is to start selling off at least state minority stakes in those assets over time and start bringing in both more foreign investment, but also foreign know-how and governance. And we saw a big announcement out of the country yesterday to that end towards privatizing other sectors in the economy, not just the banks. And so another thing that's really exciting about Uzbekistan is that they're essentially sitting on a gold mine, and you can see here we have a chart of the foreign reserves, and they made the call in, I guess, 2022 to begin increasing the portion of their reserves that they hold in gold. They do have a large gold mine in the country. The central bank has the first right of refusal on purchasing the output. And so this has been obviously a great call for them and something that I think does get foreign investors quite excited, particularly in an environment like this. And then what is also exciting here is that they have very high interest rates. I mean, it's a high growth, high inflation economy. The policy rate tends to be in the mid-central digits. We're currently earning about 11% over the risk-free rate here in the US to hold assets denominated in the local currency. And for all the reasons I mentioned, we expect to earn that full 11% or maybe just like a little less, just lose a couple percentage points due to depreciation over the year. But because there is this growth story, this reform story, we think that local assets will continue to be attractive here in Uzbekistan. So this is a country that we're typically pretty excited about, but I think the gold story, the critical minerals story, and the continued reform pace that we're seeing this year, there's more reason to be excited about it right now. And maybe we'll just
So you mentioned 11% over the risk-free rate.
Yeah.
Would that be like a 4-ish% rate as the risk-free rate in the US?
Yes.
So like a 15% yield?
Yeah, and it depends what asset we're looking at. So that would be for a government bond or a currency forward that's denominated in the som, which is the local currency. But there's also corporates that issue debt both in dollars and in local denominations, and those will offer an additional credit spread because of the corporate risk. And so our corporate team looks at investments there too. So, potentially we could earn up to like 18% over the risk-free rate if we move away from the government and look at some of the corporates that we like.
And you made a comment about a high growth, somewhat inflationary economy. You think about a country borrowing at that kind of interest. How do they look at that as far as a good use of their funds, and how is that sustainable?
Yeah, I mean, they're expecting to continue growing and to grow faster than the pace of debt accumulation. And that's obviously a risk that we need to be very mindful of, and one that we're constantly monitoring. In 2023, we saw maybe some things that were a bit concerning around the margins on Uzbekistan. So they let their budget deficit run a bit wider than they had in the past. We saw increased imports, which was putting pressure on the balance of payments, and we moderated the size of the position because the idea that they could grow out of this debt accumulation and capital accumulation looked to be not totally at risk, but some of the dynamics were changing. We saw a complete reversal of those dynamics in 2024, and as I mentioned, I think as we're here in 2025, things are starting to look even stronger. So we watch those things, but yeah, I mean, there are risks inherent in the investment as well.
What's like a position size of Uzbekistan in your fund?
Yeah, so I would say it ranges between 3 and 6%, depending on how strongly we're feeling about the story. It's not. I think one concern might be liquidity and the cost of managing the size of that position, but I think what is not necessarily appreciated here is there are a lot of tools to help manage position size. So if we buy a bond denominated in local currency, but then decide that we want less exposure, we could use an offsetting currency forward to help manage the size of that exposure. So there are more tools than it might sound like just from hearing the name Uzbekistan.
What kind of things do you learn when you meet with officials on the ground?
Yeah, we hear all sorts of things from personnel changes. I think that's one thing that contributed to those issues I mentioned in 2023. There had been a long-standing team at the finance ministry that helped implement the first round of all those reforms I mentioned. And in early 2023, the finance minister was replaced. And when I went to the country later that year, I learned that most of the key team had been told they had to reapply for their jobs, and some, I guess, felt that was indicative of their future position at the ministry and didn't reapply, and someone off to the IMF. And so you had corresponding with that difficult period, it actually was due to, or at least partially due to those personnel changes. And so that's the kind of info that you tend to really only get the key details from in a room with someone. It's hard to glean that from the news oftentimes. So really indicative of the value of travel. And happily, all that new finance minister was sent packing. The old team was brought back in, and we very much feel like the agenda has been restarted here. After that experimental period that didn't go particularly well. But typically when you're in country, you're finding out not just about the trends of data that we can see back in the office, but what's behind it and what's driving it and what might be cause for concern and what they can more readily explain. So think of like fiscal deficits getting wider or narrower. Are they worried about this? Is this a trend that they have discussions about in policy that they are thinking about putting in place to mitigate it's those sorts of questions that it really helps to obviously talk to someone, not just the policymaker, but often external observers who sit in country and watch all these issues closely, whether it's people that work at banks, think tanks, even professors at local universities, local journalists, and that really is the value of travel.
Cool, thank you.
Mhm.
Sarah, we had a couple questions from attendees here while we're on this slide.
Sure.
Can you talk about investing in a lot of the neighbors around Uzbekistan, Russia, and Ukraine are particularly interesting? And then beyond that, just how do you think about Russian aggression as a potential risk?
Yeah. So Russia, the main risk that the war has posed so far to Uzbekistan revolves around the foreign workers from Uzbekistan who go to Russia to find jobs. So this is like a traditional setup that has been in place for years and years. And I think as the Russian economy has been wobbly at times since the invasion, and also there's been, I think, more kind of nationalist sentiment in Russia and kind of anti-immigrant worker sentiment at times, probably driven by the overall political environment. We've had concerns about both the amount of remittances that workers in that Uzbek workers in Russia can send back home, but also the amount of workers that might stay in Russia versus come back to Uzbekistan and look for jobs that might not be there. And it's something that the local policymakers have, I guess, have registered concern about over the intervening years as well. Is how do we create an economy that's going to support workers who do eventually want to come home, because Uzbekistan is growing and developing, and Russia in the future will look like a less attractive place for Uzbek workers to go find jobs. So, I mean, one thing they've done is continue this reform agenda because it is very imperative that they grow the labor market and be able to provide opportunities to their people in the future. But another thing they've done is sign a lot of agreements with other nations. So think of like South Korea, places in Western Europe to take workers as well. And then, we have seen the stabilization of the Russian ruble over the last several months, as there's been, I think, a move towards some sort of conclusion to the war. And obviously that's not solidified yet. But I think that the policymakers feel that they've taken steps to make their own economy less dependent on Russia and Russian remittances. And so whereas previously the ruble, if it moved 10%, the Uzbek central bank might feel like they should also allow their currency to move 10%. You see less and less of that behavior over time. There has been some decoupling in reality and not just in perception, and so that's very healthy. I mean, obviously you can't change geography, and Russia is going to remain in the neighborhood. Not particularly worried about Russia invading Uzbekistan. It geographically would be very difficult, and it doesn't hold the same strategic or historic importance to Russia as a place like Ukraine. I don't expect that Uzbekistan will ever be seeking to join NATO either. But as I mentioned, these like critical minerals discussions, you have a lot of interested players. You have China, you have Russia, you have the United States. Uzbekistan and its neighbors will have to continue to work to balance all of these different interests. And I think they've done a really good job of that so far. Another neighbor that's done a decent job of that is Kazakhstan. And they really have no choice. It's the neighborhood they live in.
What kind of maturity are you expressing on these bonds? It's probably not like a 30-year bond, so everything has to go great for 30 years. It may be like a 2 to 4 year bond or something. So as long as they can pay their bills the next couple of years, you should be in good shape.
Yeah. So the primary asset that we're looking at would actually be non-deliverable forwards. So we tend to invest like 1 to 9 months. And this is actually a derivative instrument. The counterparty is a large global bank. For local reasons, we can't trade onshore forwards in Uzbekistan at the moment, although as the market continues to develop, that may increasingly become an option. So essentially the counterparty, the global bank, has some risk that they've developed onshore that they might be looking to offset by doing a trade with a counterparty like ourselves. And so that's our primary way of getting exposure. So our money doesn't go directly onshore through this relationship with the banks. There is presumably some investment being made onshore somewhere, but it's not our risk onshore, which is good because you avoid the potential for things like capital controls, which isn't an issue that I'd be worried about here since the capital is already very controlled. But could be, obviously an issue in other places around the world in times of stress. But another way we get exposure is through government bonds that are actually settled in dollars, but the final repayment and the interest rate is linked to the local currency. So the government itself isn't taking on dollar risk. And so, essentially when the bill comes due, they recalculate the amount that's due in local currency terms, and then they pay us back in dollars. And that's another way that we get exposure. Those bonds are typically 3 years long. We just purchased one a couple months ago. So 2 years, 10 months, something like that is the longest exposure that we have at the moment. You could also lend to the government of Uzbekistan in hard currency through what's called a Eurobond. We do have a much smaller amount of exposure there. We typically find that the spreads over U.S. Treasuries that are offered on those instruments are too narrow for our liking. But in times like early April, when all assets were selling off, we might go in and try to find small pieces of things like that at prices or spreads that we find very attractive.
Awesome.
Sarah, we got a couple more things online here.
Sure.
Who are some of the larger co-investors? Are there other countries? You mentioned pretty limited trade. Are there other countries that are investing there or other corporate interests?
Yeah. So limited trade that has been increasing since this new president has been in power here. There are in the real sector. So these are companies that are participating in real investments in the economy, not financial investments. There are companies from Korea. There are companies from China, Western Europe, and even the Republic of Georgia owns a bank, a private bank in Uzbekistan. I think that this market, which is fairly isolated from the rest of the world geographically, but also just has historically fewer economic linkages. For those that are willing to take the risk on a new name and a new market, can offer a lot of opportunities for growth. I mean, there's a decently sized population. It's young, and the economy is growing, and so you do see increased FDI interest from all over the world. And then on the financial markets side, I would say, the local currency is not in the local government emerging markets indices. So there's a lot of our competitors who just can't look at the market. But there are probably 10 to 15 or so other asset managers who might take a look. But for various reasons, whether it's inability to trade FX forward or FX derivatives, might not have as much access. And so it does end up being like a handful of other asset managers who have the ability to invest here. Part of the thesis is that's going to change over time. And there is a lot of work being done on shore to improve the legal and regulatory regime around financial markets to offer instruments that are more investable. And so at some point in the future, Uzbekistan won't be that exciting or exotic of a name for investors like myself. And hopefully, the pricing will move commensurate with that. And that's kind of part of, we at times will engage with the government to help them navigate some of these issues, and over the long term hope that that work helps them find a wider audience at higher prices that will improve the value of our investment over time as well.
I got one question that I'll let Josh field, and then we can move on to a very, very different country here. Can you talk as an allocator? Where is this in the risk spectrum, and how do you think about sizing in portfolios?
So we have a kind of like a 5 to 6% weight in our portfolios in this fund. And we like that because it pairs nicely with a lot of the other things that we have invested. So this is going to behave a lot differently than, say, real estate in the United States, or US inflation-linked bonds and the US stock market. So when we look at like a risk spectrum, this would be lower on the risk spectrum, so a lot less risky than stocks, because it doesn't have near the volatility profile. And the way Sarah's team invests this fund is Uzbekistan would have some risks that are similar to countries around it. So when Sarah's looking at her portfolio, they don't want to have too much of their fund in any particular risk. So they own investments in the Caribbean, and she's going to talk about Iceland, I believe, in a little bit. Mm-hmm. So there's so much diversification in the fund that it really adds to the risk reduction. And so when we think about risk in my view it's somewhat volatility. That's how most people think about risk, just something going up and down. But I really think of risk as losing your money. So a fancier way to call that would be the permanent impairment of capital, which is just a fancy way of saying losing your money. So when Sarah's putting all these investments together, the likelihood that the fund has, severe losses is just so low. They're very diversified. They pay a lot of attention to risk. So I think that, I don't know if that answers your question about.
Yeah, that was the question. So, Sarah, we'll jump to your next off the beaten path country here.
Sure.
Too far.
So let's see, much closer to home is the country of Iceland. And I don't know, this one might be infamous to people who have been interested in foreign markets for a long time, because they notoriously built a very leveraged banking sector running into the global financial crisis back in 2008, and were one of the first, dominoes to fall as the global economy was collapsing in 2008. But since then, they've been through enormous amounts of work to undo the excesses of that banking sector. It's very small and pretty conservative by today's standards at this point in time. Instead, they diversified the economy into tourism, continued to build upon the traditional sector of fishing. There's a lot of energy production and derivatives of energy production, so increasing data center investments. I'm sure there's some crypto miners in Iceland who are taking advantage of cheap and clean energy sources. It's an economy that's it's small, but one that's doing quite well. And so here, we're excited about a new government who's turning an eye to the fiscal spending. They think that this 3% of GDP deficit that was posted last year was too high. and they want to go about a optimization and efficiency drive. I don't think we're going to see an Icelandic Doge necessarily, but we're always interested in governments looking over their public spending to find ways to save money going forward. They also have a, yeah.
Sorry, just to triangulate. In the US, I think we ran like a 7% budget deficit.
Yeah.
So the US is kind of spending money much more aggressively and much more unsustainably than Iceland. So sorry.
That's right. But, in Iceland, to their detriment, I think a couple of things. They have this history of being known for the financial calamity of 2008. They also, they're not an emerging market. GDP per capita is too high for that, but it's certainly not a market that one thinks of when they think of the big global developed markets either. And so they're kind of stuck in this no man's land where there is no natural bond investor. And so they have to be mindful of their deficit and what they can finance. And we think that we're very happy to see governments trying to optimize deficits, even if it is from a relatively low base of 3% of GDP. The third point here I wanted to highlight was just that the central bank is fairly conservative. They've been cautiously easing interest rates. There has been some labor market tightness in Iceland that I think, like a lot of places around the world, you saw it really exacerbated post-COVID. And so there's, I think, more inflationary forces than not. And so the central bank has responded by very slowly letting interest rates come down. We actually trade the local currency here versus the euro. So we think of the risk-free rate as being lower than that 4% that we talked about for Uzbekistan and the US dollar. But we are earning about 6% over that risk-free rate in Europe. So think about like 8% overall on short-term investments. We expect that the economy is going to deliver 2 to 3% growth this year, and the currency should stay relatively stable, maybe even appreciate a little bit after a difficult fish catch last year led to a little bit of weakness. But over time, we think that things like the building out that data service sector, continuing to build on some of the wins from tourism, and good policy should deliver returns from Iceland.
Got it.
Sarah, how large or small is Iceland compared to a state in the US or anywhere in Europe? Is there a good comparison, population or GDP?
Yeah, I mean, it's tiny. I don't know. I'll confess I don't know enough about population sizes in the United States, but when you go to Iceland, people will say things like, oh, welcome to my equity brokerage. Have you been to this bank yet? My cousin is the head of research over there, or so-and-so's cousin is the finance minister. Everybody is connected in some way. And they actually had a problem with an initial privatization attempt of one of those large banks that they had to take over following 2008. So they decided they wanted to begin reprivatizing pieces of those banks. And there was an issue that came up on the political side following the privatization because I believe the prime minister cousin was an investor, and it's like that's just really difficult to avoid in a country like Iceland where the population is small and everybody either knows each other or might even be related.
What are some things you don't like? Not about
Yeah,
Iceland, but maybe a country or a currency that you have a negative view on.
Yeah. So places that we are short, and I mentioned that we are a long short fund here. And what we're looking for when we invest on the short side, ideally would be a deteriorating situation where we expect that the rate at which a government borrows is going to increase over time due to bad policy and other negative dynamics. The kind of classic example for our team that comes to mind when I say that is South Africa, where you've had a government that has a political party, the ANC, that came out of apartheid and really did some amazing things at the outset, but over the intervening decades has seen a lot of internal corruption and allowed a lot of institutions to decay. South Africa is having a particularly difficult this year. So the ANC lost its majority status in parliament and had to create what they've been calling a government of national unity, which involves several other political parties. And this is the first time in the post-apartheid world that we've seen, or at least the first time in a long time, that we've seen a coalition government in South Africa. But there is one other major political party that's involved, and that political party basically decided that they were unhappy with some of the policies incumbent in the 2025 budget. And the day that it was to be presented to Parliament by the finance minister, they said, we can't support this. And the budget had to be rewritten. It was presented again, and then that second party in the coalition again said that they couldn't support the measures, which included a VAT tax increase. And so there's been a lot of infighting. What's going to end up happening most likely is that they'll cut the expenditure side, but most likely they'll do it at the expense of the capital budget, which unfortunately the capital infrastructure in South Africa has decayed over the past couple of decades as well. And there's an X account that I like to follow that shows like the same street corner from 10 years ago and the street corner today, and there'll be all sorts of like weeds grown up and crumbling concrete and the street signs hanging from a thread or something. And so it's really pervasive. And so it's not that the government borrows at particularly high spreads. Think of the spread over the US as being like something like 2%. And so it's not that they couldn't have invested in infrastructure or other sort of necessary services like healthcare and education. It's that the money's gone elsewhere. And so we have been concerned about the fiscal situation deteriorating there for a long time. Debt to GDP has been allowed to rise to very high levels, near to 80%. And we don't expect that that's going to be coming down anytime soon. So that's a country where we tend to be short, whether it's on sovereign credit spread, so borrowing in dollars, or on the currency side.
What's a cool country you've been to that not many people have, and you would suggest going on vacation there?
Oh, goodness. Let's see. So I would say a cool country I've been to that not many people have, Mozambique comes to mind. They've got beautiful beaches. I wouldn't necessarily suggest going on vacation there because they also have developed a problem with a terrorist group that has really kind of decimated the area. And there's actually multinational forces of African armies that have been brought in to protect security.
This sounds like a good deal, perhaps.
Yeah.
Maybe I'll sell there.
I went before these issues really became exacerbated, but I don't know why that one flashed into my head, like the beautiful ocean, the sand, but yeah, don't go there on vacation right now. I mean, I will plug Iceland. Please go on vacation to Iceland. That will only be helpful. Uzbekistan as well. I had the opportunity the day before meeting started to take a train ride across the country to go visit one of the historical Silk Road cities in Uzbekistan. There's a direct flight from JFK actually to Tashkent. And then you can hop on this very relative to US standards high-speed train. And they'll take you and you can see all these amazing kind of Silk Road era mosques and tombs and an observatory from, obviously centuries ago. And it's very beautiful. The food is fresh, a very pleasant trip. And then I will, throw a plug in for Serbia. I think Belgrade is one of the most underrated cities in Europe. And it's got a great nightlife, really nice spot at the convergence of two rivers. Right now, you could go join a local protest against the government. They're actually decently orderly, but yeah, I mean, there's an amazing array of places to go, but some of them, like Mozambique, you might want to wait on.
We've got a couple minutes left, Sarah. I'm going to take a couple questions that got upvoted here and smush them together.
Sure.
So countries that are near Russia, you get a lot of questions around how to trust data that comes up with China.
Yep.
And then we got a question circulating around things like Transparency International's corruption index. Can you just talk about EM or lesser known countries as a whole and how you trust and validate data? And
yeah.
Are there shady characters in the governments? Is that a real concern?
Yeah, I mean, there can be, yes. So on the data front, I would say that the reliance on economic data in emerging markets, like you cannot rely upon it. Trends, I think, are indicative of what's going on. Exact numbers out to 2 decimal places should certainly be taken with a giant grain of salt. I mean, we revise our numbers here in the US constantly. So I don't think the idea that you could collect accurate data down to, the 4th significant figure in a country like Turkey or Uzbekistan or even, Uganda makes any sense at all. So we're looking at trends, certainly in terms of understanding what a full debt load looks like for a government. There have been cases in the past and even very recently where it turns out there were obligations that governments weren't disclosing. And we have to, I think, leave mental room for the idea that that might be the case. And obviously, we're going to calibrate how much room we're leaving based on what else we know about the economy and governance and the way that data transparency generally works there. But no one should take the numbers that they find on an IMF's website or a government website as the honest truth. I think that would just not be recommended. So we look at data, we look at trends, but we also are building a big mosaic from anecdotal information, from talking to people, from trying to find alternative sources of data, whether it's, trying to proxy economic activity by looking at flights in and out of an airport to try and get to what the real tourism arrival numbers might be or things like that. Or even in the past, we've looked at like light pollution as a indicator of economic activity. I mean, there's different ways to try and proxy things, but essentially, there's very few numbers that I think can be relied on as the end all be all. And anyone that tells you differently, I think, is not being honest.
Based on your travels, it sounds like boots on the ground is the best way to get data and verify data.
Yeah, I mean, and again, like you're not going to be able to verify a GDP number from a trip because the people that you're talking to will have that same GDP number and they can tell you like, look, we run our own study and we think it's a bit lower or higher. Or they can tell you, look, we're looking around and we just see that there aren't as many people out and about as this number seems to proclaim, but they're not going to necessarily provide you with something that's any better. You just have to build that into your overall view.
Sarah, something I talk a lot about with clients is this current yield environment where interest rates are higher than they've been recently is actually incredible for people who are not borrowing money. It's the people like our clients who are saving and investing in your fund. Can you talk about the current yield environment versus where you've seen it over your career?
Yeah, I think that a lot of countries, so if anyone's been following the headlines on emerging markets, debt issues, we had a wave, really the past 4 years where we had a number of big sovereign defaults, whether it was another one from Argentina, Lebanon, Zambia, obviously like Venezuela, Ghana, the list kind of goes on. That was a result of that low interest rate environment that we all went through. And so in times where yields are quite low, obviously anyone who can throw together an investor presentation came out and tried to borrow and at times borrowed much more than their economy could support. And we saw the result of that over the last several years. Now, with base yields being quite higher, you have much less borrowing activity. And so I actually think my personal view is that hard currency debt, sovereign debt, part of the asset class is probably going to shrink because you just have less rollover and countries are turning more towards their domestic markets, where even though the interest rates are high, the nominal GDP growth, the combination of real GDP growth and inflation keeps up with that domestic debt in many cases. So you have a lot less risky borrowing activity, which I think will be good for the asset class down the line. But countries that are still in a precarious situation and haven't defaulted yet will also will find it harder to roll over that incremental piece of maturing debt. So we have to be really careful when analyzing sovereign debt that already exists out in the market, and think about what happens if the market is just not there to refinance that maturing piece. I mean, there's a couple countries that people will name as being maybe particularly at risk for being among those last dominoes in this wave of defaults. There's some that I'm not so worried about. Tunisia is one. They have essentially one more Eurobond that's maturing next year, and they have the central bank reserves to cover it. They have a great relationship with their neighbor Algeria, who gives them large amounts of dollars when they ask. And so we have a more authoritarian president there, and he would like to undo a lot of those international linkages that put pressure on his ability to I guess, maneuver in politics the way he would like to. So we think they'll find the money for that one. But there's other countries like Angola, for example, where oil prices are a big part of their kind of going forward ability to pay their debt. So that's one that we've become more concerned about recently. And that's a position change that people might notice in their portfolios.
That gets us at time. Sarah, thanks so much for joining and talking to us and our clients.
Sure.
Great to hear from you.
Yeah, thank you guys for having me.
Yeah.
If I can make one comment about Uzbekistan, they have also done a lot of work on issues like child labor in the cotton sector, and they're moving up those corruption perception indices. So we're looking for change on the margin. Nowhere's that's going to offer very high rates is going to be set up already with perfect governance, but we want to see things improve. That's where we think the real important thing to look for is, and we're seeing that. So I didn't want to ignore that question, but thank you.
That's great. Thanks.
Yeah.
Appreciate everybody that joined. We had 50-some folks on the call today. Really great to have you all with us. We'll do another one of these next quarter, so we'll get a a date and a topic out to everyone. If you have any questions, as always, reach out to your primary advisor here at the firm, and we look forward to talking soon.
Thanks, Sarah.
Thanks, guys. Bye.
See ya.